Hello traders and investors, and welcome back to Explain the Charts. Today is October 1st, 2025, and we are diving deep into the Nasdaq 100 ETF, the QQQ, which is experiencing some absolutely extraordinary volatility. First, let's cover the news, because the macroeconomic environment is a whirlwind of conflicting information. On one hand, major news outlets are reporting general market strength, with Wall Street largely shrugging off the government shutdown, viewing it as a political sideshow rather than a market-moving event. Furthermore, the latest ADP private payroll report showed a surprising contraction in jobs, which has sent the market's expectation for a Fed rate cut this month to a near-certain 100%. Ordinarily, the prospect of cheaper money is a massive tailwind for the growth and tech stocks that dominate the Nasdaq. We also have major tech earnings on the docket, with giants like Meta and Microsoft reporting this week, which investors were anticipating with optimism. This paints a picture of a market that should be bullish, buoyed by the promise of Fed support and strong tech fundamentals. However, now let's turn to the charts, because the QQQ is telling a completely different and frankly shocking story today. Looking at the daily chart, we can see a powerful uptrend that has been in place for months, culminating in a new all-time high set just yesterday, September 30th, with a close at $600.37. But today, the market experienced a catastrophic gap down, opening around $487 and selling off hard throughout the day. This move has wiped out nearly 6 months of gains in a single session, plunging the price back to levels not seen since early April. This is a massive reversal candle that completely engulfs the trading of the past several months, signaling a violent and decisive shift in market sentiment. This kind of price action suggests a major, unexpected negative catalyst has hit the market, something that has completely overwhelmed the bullish narratives we just discussed. Let's zoom in on the daily chart for the last month to really appreciate the scale of this reversal. You can see the steady, confident climb throughout September, pushing past previous resistance levels without much trouble. The price action looked incredibly strong, building momentum right up to yesterday's peak. Then we have today's candle, a brutal move downwards that shows the bears have taken absolute control. The primary resistance level is now the enormous gap left on the chart, from today's high of about $488 all the way up to yesterday's close near $600. On the downside, the immediate support is the low of today's trading, right around the $477.40 mark. If that level fails to hold, the next major support zone comes into play from the lows back in March, roughly in the $468 to $472 area. Now, let's look at the 15-minute chart from yesterday, September 30th, to analyze the market's behavior right at its peak. As you can see, the day was characterized by a push to new highs followed by a strong consolidation. The price held its gains well and closed very near the session high. Crucially, there was no significant selling pressure or clear topping pattern in yesterday's intraday action. Nothing on this chart suggested that a more than 18% gap down was imminent just a few hours later. This reinforces our theory that today's collapse was not a technical breakdown, but a reaction to a powerful external news event that blindsided the market. So, to recap the situation, let's return to the daily chart and outline the scenarios going forward. The market structure has been severely damaged in a single day, and the technical picture is now overwhelmingly bearish in the short term. The massive gap between $488 and $600 will now act as a formidable resistance zone for any potential bounces. Immediate support is the low of the day at $477.40, a critical level for bulls to defend. Let's talk about the possibilities. For a bullish case to emerge from this wreckage, buyers must establish a strong floor at the $477 level. We would need to see price stabilize here and begin to reclaim ground above $480, and then make a push towards the psychological $500 level. However, given the force of this sell-off, a V-shaped recovery back to the highs seems extremely unlikely. I'd place the probability at less than 10%. This would require a major positive catalyst, perhaps blowout earnings from the remaining tech giants or a surprisingly swift resolution to the government shutdown. The bearish case is, for now, the primary trend. The path of least resistance is lower. If sellers break today's low of $477, a move down to test the next support zone around $468 is highly probable. I would assign a 70% likelihood to this scenario in the coming days, especially if we get any negative earnings surprises or further signs of economic weakness. Looking ahead, the things you absolutely must watch are threefold. First, does the $477 support level hold? Second, what are the results and guidance from the upcoming earnings reports of Microsoft, Meta, and Apple? Their performance could either fuel this fire or provide a much-needed lifeline for the market. Finally, continue to monitor the headlines for any developments regarding the government shutdown and any new commentary from the Federal Reserve. The market is now in a precarious position, and the next few days will be critical in determining the trend for the remainder of the year. Thank you for joining me for this analysis on Explain the Charts. Let me know your thoughts on QQQ in the comments below. Don't forget to like and subscribe for more in-depth chart breakdowns.